Good morning, ladies and gentlemen. A very warm welcome to you on Business Today Television. We continue with our series of market gurus, excellent stock pickers, bottom up specialists who pick up value over growth and at times put in money in strong growth as well. People who have over long periods of time outperformed the broader markets and created phenomenal wealth not only for their clients but also for themselves. We are now joined by Shri Aditya Sood, fund manager at InCred Asset Management. The PMS company runs two schemes, a multi-cap scheme as well as a small and mid-cap portfolio. Overall, the assets under management are 2,000 crores, and over a period of time, we will continue to show their portfolio on the screen. Namaste to you, Aditya ji. Again, a very warm welcome. It's always a pleasure to listen to your investment thesis at a time when pharma is making a strong comeback and you have the heaviest weight within this sector as far as both your PMS schemes are concerned. Tell us first, how do you feel about the markets at this point of time? We've had a very strong rally from the low of March till about early July.
Thanks for having me on the show. Indeed, it is a pleasure. I think so. The context of market, post in last 2 months has completely changed. But there are few structural things that I want to highlight. One is that the risk-free rate in India has virtually collapsed. So if you look at the 10-year bond yield in India, it is, trading at 6.3%. We are in a very low inflation environment. I have not seen consumer inflation being at 2.1%, which was recently reported. More importantly, apart from the risk-free rate coming down in India, the risk premium that India used to have vis-a-vis other emerging markets has virtually collapsed. So if I look at the differential between Indian bond yields and US, which is, closer to 1.3%, last 20 years as an investor, I've never seen, that differential being, it used to be as high as 4.5%. It is 1.3% today. The third element which is happening in the market, obviously, is that money has started to move out of US. Last six to 9 months, we have seen that. And this is having two, broader repercussions. One is that dollar index, we have seen, 11% fall in the dollar index since 1970. We have never seen a 11% fall, which is within such a small time. So there are two implications for US investors here. One is that, obviously US has a phenomenal run post the global financial crisis way back in 2008. People have started to believe that US possibly is topping out because US markets are not cheap. If you look at market cap to GDP, it is, essentially in excess of, 200%, which we have not seen. This is a classical Warren Buffett indicator, essentially. So US is not cheap. The first port of call when money was moving out of US was to go to cheap markets like South Korea, for example, within emerging markets. South Korea, incidentally, is up 40% this year. Spain is up 30%. Some of the markets in Europe were trading at 10 to 12 P. But obviously, this money will find home, and this money, more importantly, will chase quality. So our belief is that, and that is why we have seen this reversal in FIF flows in India, which has been a big relief for all the market participants. Obviously, domestic flows have been, very supportive. But going forward, what is going to be the key in our view is earnings growth. We have had a 5% earnings growth last year, after 25% earnings CAGR from 2020 to 2024, which obviously I can call it as an aberration because the long-term earnings trend last 20 years has been more like 12%. So in our view, we are mean reverting in terms of earnings, and this is going to be a very different market to invest going forward. You would have to forget about, whatever has happened in last 4 or 5 years. Possibly this is going to be a very different market going forward. And our belief is that as a logical consequence of this, concentrated portfolios typically will do well. And, it is going to be a stock pickers market going forward.
Okay. Aditya ji, let's against this background that you've mentioned, let's look at the first quarter performance. What are you expecting from your own set of 11, 12 companies that you own? Ladies and gentlemen, Aditya runs a very concentrated portfolio. About 28, 25% of 2,000 crores is invested in healthcare stocks such as hospital chain Indraprasth Medical, Newland Labs, and of course, companies like Healthcare Global Enterprises, and of course, stocks such as Tasty Bite Eatables, Religare Enterprises. But primarily, it's a very strong healthcare hospital play. First, your opinion on first quarter earnings, anything worthwhile that you see, and then of course we'll be discussing the healthcare side of business, which is doing extremely well, especially hospital stocks.
So on the earnings bit, I think so. Our very simple expectation is that we are getting into a 10 to 12% mean reverting trajectory as far as earnings are concerned. Specifically for small and mid cap companies, what matters is that, last 7 months we have seen earnings getting downgraded, right? And it is a cycle which in our view is coming to an end. Because if you logically think about it, after 25% earnings growth for 4 years, no one expected that in an election year, earnings are going to fall off the cliff in the sense that we will only grow at 5%. I think so. We are mean reverting, and obviously there is a overhang of tariffs. Nobody has clarity. At least the trade will take a lot of time to readjust to this new clarity in terms of tariffs. That is what we are essentially, hoping for. So our focus at a portfolio level has been to invest into companies wherein you have visibility in terms of earnings growth, and secondly, you don't buy expensive stocks basically in this environment, because when we saw a 5% earnings growth from FY24 to 25, that itself created an opportunity wherein a lot of stocks corrected by 30, 40, 50% from their peak prices. And we believe that to buy into a combination of earnings growth and P multiple expansion is a better combination to focus on. And that is why we focus on growth at a reasonable price versus growth at any price, or we focus on value, wherein we see, stocks correcting by 30, 40%. A recently IPO'd company could have fallen by 30, 40%. So that becomes an area of interest for us, because obviously we would like to outperform in a flat to a low growth expectation environment. So earnings growth is a very, very powerful tool. So at a portfolio level, what we have ensured is that there is very resilient portfolio, and obviously it is also growing at 2x of the market expectation in terms of earnings growth.
Okay, perfect. Earnings might be one thing. The other thing is what your investors and customers look at, which is market performance. Aditya ji, because two of your stocks are widely held. One is Tejas Networks, the other being Newland Labs. Both of them underwent a serious bout of correction. Newland may have improved over the last 1 week or so, but Tejas continues to disappoint. Is the earnings thesis vitiated with the quarterlies that you've seen at Tejas, or is it one of those things it's a cycle and you've seen 1300, so we will also see 650, one of those things?
I think so. It is a bit of both, but let me, walk you through what we actually believe in when we look at, these smaller companies which are in niche areas, basically. One is that you have to be an early identifier of a trend, right? So CDMO might sound like a very, very fancy word today, right? But it was not a very fancy word, when we first looked at Newland way back in 2011, basically, right? And there have been various iterations. So the way we think about any business in this country is that first 10 years, if you start a business, you are solving for positive unit economics, coming up to scale, and you are solving for balance sheet. The next 15 to 20, 10 years go
Okay.
solving for gaining market share with your clients, right? And increasing that wallet share over a period of time. But once you are into the business for 20, 25 years, the next 10, 15 years look very, very different. And it is not a coincidence that both these companies that you talked about, if you look at Tejas also as an example, when Tata's did a corporate change event in Tejas, it was exactly 25 years into Tejas history, right? And we have seen top line growing from 537 crores to 9,000 crores in last 4 years, right? Since the time they came into, sort of
Yes.
being business owners of this business. And we have seen profitability moving from 37 crores to 450 crores, 440 crores to be very precise, right? So just think about this that
Correct.
if a ownership changes and their complex of business, if you look at their product mix, it was known to people that Tejas is a fiber to home champion, in the sense that they excelled in BharatNet. Now,
Yes.
the beauty about the investment thesis today is that they have successfully implemented wireless for BSNL. And initially, people thought that, this is a B2G business because, a consortium of TCS, Tejas, and Tata Communication is involved, right, to get this business. But if you look at 90,000 towers that they have already implemented, BSNL will require, at least 1 lakh towers. This is our expectation. This is not, I mean to say, this is widely known in the press, right, that BSNL would look to expand. But look at now what is happening on the BSNL end, right? 2 quarters we have seen BSNL being profitable, right? 250 crores PAT, in
Yes.
Q3. Q4 was, more like, 260 crores PAT. Our belief is that, it is a world-class solution that Tejas has provided. Obviously, this is part of Make in India. You have got the PLI benefit. So if you look at this thesis in totality, our view is that they can add another 1 lakh towers from BSNL, which is going to be a immediate opportunity, roughly quantifiable to 7-8 thousand crores of order backlog. 5G they would have to implement, which is going to be another, out of 2 lakh towers, if I have to hazard a guess, it is going to be 20,000 odd towers, 20 to 40,000 odd towers in BSNL 5G. Plus, they are investing very, very heavily on R&D. Let's not forget that their investment in R&D today is $80 million. I have not seen a small cap company in India having 550 patents and doing, $80 million of R&D investment, right? I think so. All this adds to credibility. And in a $180 billion market, and this is what the telecom networking equipment market is today, Tejas is like a nobody, right? So our view is that over a period of time, even if they have to get a 3 to 5% market share, this top line has to exponentially grow. And I'm using this word very carefully, right? But this is one such market wherein you are backing possibly the best corporate house in the country which understands technology. And our view is that, all this doesn't come with, too much of dilution, because at the end of the day, what they have done ensured is that, they have the R&D strength has moved from 400 to 1800. So it has not come at the expense of, too much of dilution. So I think so. It is a very, very high capability company. These 30, 40, 50%, drawdowns happen in stocks, in small or mid cap investing. It also incidentally happens in large caps. It is all a question of how much conviction do you have and what is your horizon of investing. So typically, my view is that if you can find
No.
3 or 4 small cap companies that become mid cap and eventually become large cap, that is what real investing is all about. So over a period of time, it is a business of going fast and slow in terms of, allocation. And this is what we have ensured, possibly at a 1300 or 1100, the Tejas allocation for us was not very high in the portfolio. But, after a 50% fall, obviously it makes a case of, buying more because the thesis is still intact.
Yes. Yes. My base question was this, that the stock may have halved and of course it's in a blue water kind of a situation where growth is remarkable, and of course telecom is critical for national growth as well. So the investment thesis at Tejas remains or in fact improves once the stock has halved.
Yeah, it does in a way, right? Because you have to look at the margin of safety. If I am buying today, I have to assess what is the risk to
Yes.
reward. So if I'm saying that, I'm buying Tejas today, possibly, the stock can fall by 10-15%. That is fine. It can happen to any stock. But what is the option value that you are buying today? If you are investing for, let's say, 3-5 years is what you need to really assess. So in these companies, which are very, very high capability, our view is that the option value is immense over a period of time. And this is what has happened to, multiple companies in my career. I still remember I used to own from 2014 to 18, we used to own, Trend. Nobody would have imagined the small cap will go into the index, right? But the investment thesis there was that there was a learning from West Side, which they obviously tried to improve by having a Zara JV. Nobody knew that whether they could have morphed into a Zudio, right? So my very simple point is that what Tejas can morph into going forward, because they were a fixed line operator, they have added wireless to their foray. They are doing global partnerships with NAC and Rakuten. Uh, then possibly, obviously they are talking about some opportunity from, essentially the Railway Kavach program of Government of India. So we'll see how these companies, the thing about, buying these small, beautiful niche companies is that business models evolve over a period of time, right? So what they morph into would be very difficult. For example, in the case of Newland, Newland is a very, very specific small molecule CDMO player, right? Now, whether they can have a breakthrough in terms of having a large pharmaceutical company, right, which is typically defined as big pharma in the pharma parlance, which is a combination of a Pfizer, Merck, Bristol Myers Squibb, right? Now, the base of profit that Newland is making today, right, is so small. It is like a 300-400 crore profit company. The single drug like Cognifi can have a $300 to $500 million top line and 90% gross margin sort of capability. And that is the reason why the Newland stock has in last 3 years that we have held the stock, the stock has moved from 1,200 rupees to 14,000-15,000 rupees over a period of time. So the point here is that if you can identify inflection point in some of these companies, obviously this is very, very rewarding for investors.
Okay. Do you think Newland ran much ahead of its valuations at certain point of time?
Yeah, it did basically, but it is also a factor of, for example, the recent rally that we saw in last 1 week. Our sort of very simple expectation there is that the part of that rally happened because of, the new IPO filing by a company known as Anthem, which is coming for listing. It is also a CDMO player. So sometimes what happens is that, the sector becomes a very, very popular sector, essentially, right? And when that happens, obviously there is PE multiple re-rating across the sector. So we have seen, Laurus, Cohance, DVs, Newland, all the CDMO players getting re-rated in terms of, PE multiples. But one thing that I would like to point out is that if I have to compare CDMO valuations today, Newland possibly would still be the, cheapest stock to buy. If I have to compare PE multiple of these companies in FY 26, 27, because, this is one business wherein you have got decent visibility of earnings until and unless you have a regulatory pitfall, right? And that is what makes me believe that, you can look at, FY 26, 27 earnings, because you have got visibility in terms of those earnings getting delivered. Newland would be still the cheapest CDMO stock to buy.
Okay, fair point. That's a very good defense of how the portfolio is shaping up. How about two hospital stocks? The top holding on both funds is Indraprasth Medical. In fact, it's a double-digit holding in terms of percentage. The stock did show some signs of flavor and gain, but compared with its larger peer, maybe Apollo, Narayan Hirdale, Kim's, Rainbow, there doesn't seem to be let me just put it bluntly, it's not got into the momentum that it could have.
Sure. So, it is a value stock. When we first invested into this company, the stock price was 160 rupees, and I'm just taking, 15 months back. What we saw in this company was that, there was the element of growth was missing in the sense that they have 755 beds. They are a single hospital. Um, you know, uh, those 755 beds, essentially, and the logic of growth was missing was that this is a quasi government of Delhi owned hospital, right? Equally owned by Apollo. And, the way we were looking at the sector was that, we have held Aster DM, we have held Narayana in the past. We obviously have HCG today. So our view was that, we'll buy something, cheap in the sector. So when we looked at the company, it was trading at 10 PE, 5 times EV by EBITDA. We said that, it is very, very cheap. But we had to solve for growth in this company. And what we saw in the balance sheet was they were having 200 crores of net cash. And this is the first time in their history wherein, now that net cash number has gone up, it is more like a 300 crore number. So what we were very confident is that, they will either dividend out this 300 crores or they will expand. Now, when we met the management, what they clearly highlighted is that from 755 beds, they can go to 2000 beds. Now, last year they did a PAT of profit after tax of 170 odd crores. So our view is that, if they will move to 2000 beds, and the ROC incidentally of Indraprasth Medical is the highest in the sector. It is a 35% ROC hospital. And the reason is very simple because the land is on lease from Delhi government, and land is, if not more, it is 40% of capex cost of a greenfield hospital. So our view is that, over the next 4 or 5 years, these 755 beds will move to 2000 beds, right? The option value that you have here is that, this 170 crore profit can become a 400-500 crore profit. The stock is still reasonably priced, because the market capitalization is closer to 4,500 crores, 300 crores of net cash. Now, the beauty about this expansion is that, it doesn't come at any cost in the sense that, it is not funded by equity dilution. 1.25 crore per bed capex if you have to take. This is a 1,500 crore capex, all funded by internal accruals and a bit of debt. So we see a long runway for this, expansion, profitability growth. And what we have experienced in the past is that if a value stock becomes a growth stock, that is immensely rewarded by the market, in our view. So that is on Indraprasth Medical. On HCG specifically, we have seen a private equity player now, sort of having a corporate change event there. If I look at the metrics again on valuation, if I have to compare HCG to other hospitals, hospitals, by the way, is not a very cheap sector to buy into today, but we have been holding HCG for last 3 years. And this corporate change event is a trigger in terms of, improving corporate governance in the company. And more importantly, improving the way the hospital is run and managed. Oncology is a very, very interesting space. It is, as you are aware, that HCG is only focused on, sort of oncology. In oncology hospitals, typically what happens is that when you set up a hospital and if you have to set up something like a cyber knife, for example, in a hospital, it is the capex is front loaded. So in that case, what typically happens is that your return on capital is depressed when you open the hospital. but obviously over a period of time, it improves because all your investments are upfronted. So the ROC looks very, very depressed initially. But if you look at, ROC 3 years, 5 years, 10 years down the line, it obviously looks, very, very interesting. So we like this space. Our belief is that, today if I have to, look at or speak to my own relatives who are, based out of either UK or US, people want to come to India in terms of, India is broadly, 1/7 the cost in terms of, any major medical procedure that you want to have. So our belief is that, essentially that it is very, very cost effective. More importantly, you get best of the access to doctors essentially. And this is one, sort of sector wherein margins pre-COVID for hospitals used to be, 7 to 10%, and margins today are obviously as high as, 20 to 30%. Essentially. So our view is that, this is a structural growth sector. And what we have also seen over a period of time is that, once you, cross $2,000 GDP per capita, your expenditure on healthcare grows disproportionately in any economy. And there is no exception in the world to this rule. So our belief is that, our expenditure on healthcare is only going to go up structurally in a country like India. And that obviously gets reflected in the pharma index performance or, these hospital stock performance as well. Hospitals have been the best stock to invest in, not, in the region. In fact, in Asia, one of the best sectors to invest into has been hospitals. Yeah, so this is a broad thesis.
Aditya ji, there is absolutely no fault in the theory that you mentioned as far as hospitals is concerned. The only issue is that the government is getting very, very anxious when it comes to, rising average revenue per operating bed as far as these hospital chains are concerned. This is all really, really very good for shareholders and long-term wealth creators. But, सरकार वोट पर चलती है और वोट जो देता है वो कॉस्ट बहुत देखता है. Anyway, we agree on the thesis that hospitals have been great value creators and they will continue to do so in the times ahead. Now, these are the top 10 stocks, some of them that we've discussed in the two portfolios that InCred manages. Lower down in the portfolio, are there any new additions that have come up?
Not really. The portfolio has been very, very stable. We are of this view that possibly markets are getting into now a sideways sort of a zone. And the reason is, very, very clear that if we don't get, earnings growth, possibly, we are going to get into a sideways sort of a zone. Some of these companies, obviously, we have seen a recent very large fund infusion in Religare Enterprises, essentially. So our approach has been more driven by adding weights in the companies that we already own. Some of these stocks, obviously have seen a 30, 40, 50% decline very, very recently. That happened to a Tejas network, which we discussed. It also incidentally happened to Newland, wherein stock corrected very sharply from 18,000 to 10,000 rupees odd. This similar kind of thing happened in, Religare. 3 years the stock has been flat. And now we have seen a, very large 1,500 crore infusion coming from the Burman family and, the existing investors. So our belief is that, we would like to buy into defenses. If you look at the underlying business that Religare is into, essentially, it is a function of Care Health, which is one of the, it is the second largest independent health insurance provider in this country after Star Health. And obviously, at some point in time, our expectation is that, Care is going to get listed, because you have already a private equity player who is holding that company. So not really, we have added any new stocks in the portfolio, but we are increasing weights because we believe that the when we are buying a sector wherein there is a lot of headwind, for example, Arman Financial, which I have obviously spoken about in the past. Nobody believed that you could have made money in MFI, but our approach has been to buy the best company when in the worst of the times, essentially. And the stock had corrected by 50%, and now we have seen a very sharp rally in the stock. In the sense all the MFI stocks have done well, and as a logical consequence of that, obviously Arman has also done well. Not necessarily that. The headwinds have abated in the sector, but obviously, the price will move in anticipation of the headwinds getting abated. And obviously, the RBI has been a key catalyst here in terms of, all the NBFCs. The kind of liquidity that we have seen is record today. I think so. There is lack of lack of impulse to do capex in the market. So our focus area is to buy more of what we already own. Yeah.
Yes, I think there is a lot of logic in what you say to keep on adding to your thesis, keeping the margin of safety in mind. Thank you, Aditya, as usual, for this very strong but very polite defense of 3 or 4 stocks in your portfolio, which form a major chunk of the AUM. Some of them have halved, many of them have reversed. Let's hope for the best. These are volatile times for mid caps and small caps. They, over the long time, create the maximum amount of wealth that investors can hope for. And I'm sure this is a down cycle, but like all cycles, there will also be an up cycle. Thank you for your time.
Thanks a lot. Thank you for having me.
That, ladies and gentlemen, was Mr. Aditya Sood, fund manager of 2 schemes, a multi-cap and the another one a small and mid-cap at InCred PMS. Mr. Sood manages 2,000 crore rupees in both these funds. They are concentrated bets mainly in healthcare stocks such as Indraprasth Medical, Newland Labs, as also healthcare HCG, that's the name of the stock, priced at about 575, a hospital chain specializing on the oncology side, and of course stocks such as Tejas Networks, Religare and Igarshi Motors. I hope you enjoyed the conversation with Aditya, and of course his very strong defense of Tejas, Newland, Religare and of course Indraprasth Medical. Thank you for watching.
If you like the video, do like, comment, share and subscribe.